Hey, in today's video, we're going over the 4 fundamental investment rules. Coming up next. Hey, this is Mel Stubbs. I'm a financial planner here at Christy Capital Management. I've got Brandon Christy, who's one of the owners of Christy Capital, and we're going to be talking over what the fundamental investment rules are. And so I looked up fundamental in the dictionary, and I got a central or primary rule or a principle on which something is based. So today we're going to go over 4 fundamentals, starting with Brandon.
Great, thank you, Mel. Well, the first of the 4 fundamentals is to determine your investor profile. How much risk is right for you to take in your portfolio? Or we've commonly heard it, how well can you sleep at night while the market is doing crazy things, going up, going down? And in that regards, there are several elements that we need to walk through and think through. One, can you sleep at night? Number 2, how much money do you need in the short term? Typically, the shorter the term you need the money, the less risk you can take in that. Often we bucket money sufficient to get you through the next few years of spending, allowing us to take more risk as appropriate for you as an investor with some of the other money that you have. All that weighs into the investor profile. Taking a risk tolerance questionnaire is critical to making sure that you align your investments with who you are as an investor. It's a mirror where you have to look at yourself to determine how much risk you're willing to take. It's very common for us to want to jump into the market when it's doing well, and when it's bad to jump out. Well, that typically doesn't work for the long haul. So we're better off to determine who you are and align your strategies to that particular style of investors. Now, the good news is we have access to a risk tolerance questionnaire right here on the screen. So please click on that and follow through to see what level of risk you can take. And that'll lead us right into the next thing. Mel?
Yeah, so once you know your risk tolerance questionnaire score, once you know how much risk you want to take, you need to allocate the funds, allocate your investments that way. So for a lot of people, they're thinking, well, how much money needs to be conservative? How much money needs to be aggressive? And so that is important, but we also need to go one step further to look at the tax status of your funds. Not only do you need some conservative money, maybe you need some aggressive money, but you're probably going to want some non-qualified money, meaning that's money that doesn't have any fancy tax advantages. You're going to want to have some traditional money. Most people have a lot of traditional money. If anything, they are traditional heavy. That's traditional TSP, traditional IRA. That's money you're going to pay taxes later on. And then there's also Roth money. This is tax-free money. So as it grows, you can access it later tax-free. If you abide by the 59.5 rule and the having the account for 5 years rule. So not only do you want to allocate money based on how much should be aggressive, how much should be conservative, but you really want to allocate money on having some non-qualified money, having some traditional money, having some Roth money. The reason you want separate money is you may need to take a distribution one day. So let's say maybe you're buying a house, maybe you need a down payment for the house, buying a car, you need to take out $50,000. Well, if all you have is traditional money, then all you can do is go to the traditional account and you're going to be taxed for it. But if you have options, if you have some non-qualified money, when you take that distribution, you're only paying taxes at the capital gains rate, which is usually better than the traditional, at your tax bracket rate. So non-qualified might be an option where you might want to take money from it. A Roth account. Lots of people work hard to get money in the Roth account. They want it to stay there forever to grow. But if you need to take out a large distribution, if you take it from Roth, you don't have to pay taxes at all. So having these options are good. So when you are allocating your money, you need to follow the risk tolerance questionnaire, figure out how much is aggressive, how much is conservative, but also be thinking about the tax status.
Mel, that's great. The key word that comes to mind is diversification, right? You're not only diversifying between different asset classes, some more aggressive, some more conservative, but you're also diversifying in different tax strategies. And we know from study after study, diversification is a key element to successful retirement planning. So I think that's spot on to allocate appropriately.
Yes. So once you've allocated appropriately, over time, hopefully if you've got some stock market money, over time, the stock market may do well. During maybe 2019, 2020, 2021, the stock market did really well. So if you are a 50-50 person, so maybe when you allocated, you had half of your money conservative and half of it aggressive. Well, if the stock market does well over a long period of time, you will no longer be 50-50 anymore. The stock market piece of it will have grown more, and you're actually taking more risk than you mean to. So you may need to reallocate. So looking at your investments, how much is aggressive, how much is conservative, maybe redoing a risk tolerance questionnaire years later. I'm finding that lots of people, as they get older, they get less risky. And so you may need to reallocate for that reason. But then also you may need to reallocate on the tax diversification. Most people are traditional heavy. They did most of their savings in the traditional TSP or 401k, so they have a lot of traditional money. Well, part of this reallocation can be doing Roth conversions, where you take a piece of the traditional money and you move it to Roth each and every year, so that over time you start building up a larger Roth account.
You know, Mel, at the end of the day, this is really not about saving money, it's about spending it later. And I think you are bringing up great points that we want to build money in such a way for the express purpose that we can spend it maximizing its benefits later in life. I think that's well said. Now for the fourth point, we want to make sure that in our investing we're not going with the flow. Now, over 20 years in this business, the number one question I get at work when people find out what I'm doing when I'm on vacation, anytime in my life, the question is, well, what do you think the market's going to do? And my answer is, I don't know. I don't know tomorrow. In fact, prophets in the Old Testament, when their prophecies didn't come true, you know what they did to those guys? They stoned them. I'm not interested in that end for me. So I think we need to understand, as we try to go with the flow or go with the crowd, a lot of people are guessing at what's about to happen in the marketplace, and we are not able to see the future clearly. There may be indicators in general flow and direction that the market may be heading, but I've been in this business long enough to know that things change on a dime, and they can change rapidly and unexpectedly. So be careful when you're going with the flow and someone comes along you at the water cooler and says it's time that we invest in this, or you better get out of that, and that pressure is put on you to act upon what really is, you ready for these two words? What's fear and greed. Yes, I said it, fear and greed. When those things well up inside of you and you act upon those things, that's when bad things happen in the investing world. So you are better off to take these principles of knowing who you are as an investor, allocating based on that knowledge, reallocating from time to time, not based on what might happen in the market or might not, but based on who you are and what your financial plan is as a whole, to invest like that and then stay that course. Have a steady hand at the wheel so that you can have a 20, 30, 40-year run of success with your retirement funds and enjoy the retirement that you want. If you jerk around, move around too fast, that's where it will cost you much more than you want to pay. So again, the fourth point, do not go with the flow.
So if you like these strategies, but you're not sure how to implement them, and you want to work with a professional that does this all the time, reach out to us at Christy Capital Management. Go to christycapital.com, call the number on your screen. We'd love to work with you. My name is Mel Stubbs. That's Brandon Christy. We'll see you on the next video. We need to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We're going over general principles and ideas that can be used, and if used correctly, can save and avoid taxes. You're going to want to work with someone personally who knows your situation personally. So seek out advice from an independent financial advisor. This is for educational purposes only. I hope you enjoyed the video.